Are you ready for a mystery? Today we're going to unravel why we are not seeing a recession despite a severe collapse in the money supply. I'm going to bring you this information, which was based on this article right here. I'll link it in the sources. Stick around to the end because you're not going to believe what's actually happening behind the scenes. You can look at this data in detail and you will start to see that there's much more going on than we're going to get in the mainstream news. Here we go, right off the bat. What if I told you that we're actually in the middle of a recession, but it's like a chameleon blending into its surroundings? Curious how? Stay with me as we dive into this. This elusive recession has a name, a stealth nationalization of the economy. A big name, yes, but what does it mean? The economic pain from the monetary collapse and rate hikes isn't being shared equally. It's like being at a dinner party where a few guests are enjoying the feast and the rest are left picking the crumbs. Now, who are the ones that are feasting and who are left, eating those crumbs? I'll show you that right here. Families, families and small businesses, they're the ones shouldering the burden. Meanwhile, big corporations and governments are having a grand time at the feast. When the state, which accounts for 40 to 60% of most economies, keeps spending and consuming, the GDP figures don't show a recession. Why not? I'll tell you. So this is the secret. High government spending is like a master of disguise, masking a recession that's happening right in front of us in the private sector. And the ones paying the price? You and I. Through declining disposable income, real wages, and the struggles of the small and medium business. But it gets more interesting than that. You see, there is a global shrinkage in money supply that it's jaw-dropping when you look at this on a year-over-year percentage basis. The government debt is actually rising at the same time. This is draining liquidity from the private sector. And how are the central banks responding? Let me explain. Central banks, in their infinite wisdom, are hiking rates. To our families and the small and medium-sized businesses, this is like a punch in the gut, okay? But the big corporations, they're having a field day. They are accessing credit and financing themselves at rates that would make a nation blush. There's a problem with that right now. You could look at this, and I think it's important, and he makes some good points. There's a twist though. Why isn't inflation reacting faster to the rate hikes? It's a good question. This might be a surprise to some. The state is the largest economic agent and doesn't care about imbalances and keeps consuming the more units of newly printed money. So the government could spend an infinite amount of cash and had over the past few years. We saw that. This certainly offsets the drop in real private consumption and investment, keeping money velocity from falling to a degree, despite the decrease in the money supply. And that's not the end of the story. As access to credit gets tougher for households and small businesses, guess who tries to play the hero? Governments step in, creating more entitlement and subsidy expenditures with the units of currency that are losing their value by the minute. This creates a vicious cycle of inflation that once it starts is hard to stop as a freight train. And here's the cherry on top. Attempts to normalize monetary policy, like raising interest rates, aren't paired with normalization of government spending and deficits. The result is what? Stagflation. We're seeing families, businesses that are, quite frankly, the backbone of the economy being squeezed. What does it mean for you and your wallet? Well, we're in the middle of a recession. Whether you want to call it one or not, and depending on what statistics that you use, really all depends. But it's affecting everybody, not just the ways that you might expect. The official data might not show it. It's there. It's hiding in plain sight. You got to look at this for what it is. You could point to a specific statistic, but it's not going to tell the whole story. And that's why we need to look at this data and understand why. Why is that the case? And we can see that here. With all that government spending, with the increase, by the way, in what I should say decrease, basically, in the Treasury's general account. So the Treasury, they have like a checking account, the Treasury General Account, or the TGA. That declined all the way, basically almost to nothing. And so that constitutes spending and was acting like stimulus. At the same time, you have the reverse repos, which do their own thing. All of this creates a stimulative effect that I talk about in the money mirror method. That's right behind me. That's my indicator that I look at. That tells me what's going to happen with the markets. This tells me that we can certainly balance things out, but it doesn't ever help you. Isn't that the way things seem sometimes? How we're always getting the short end of the stick as individuals. Some people, not so much. They could benefit from all of this, and they certainly do. But for the general public, it isn't the case. So there are things that we can do. Number one, if you want to know, you can check out the money mirror method, and I have a whole playlist that's called Financial Education, where we can get to the next level and help ourselves. Check it out, and I'll see you there. Take care.